Welcome back to Am I Catching a Falling Knife, where we cut through the noise and get to the real story behind sharp stock drops. Today, we're talking about Deere Company, ticker DE. Deere stock has taken a hit. So, is this a value opportunity or is there more pain ahead? Let's start with what triggered the plunge. Deere's Q3 2025 earnings came in below expectations, but the real kicker was the guidance. Management cut its full-year net income outlook from $7.5 to $7.75 billion to $6.5 to $6.75 billion. That's a pretty hefty downgrade, and the street did not take it lightly. The market narrative right now? Cyclical slowdown meets margin compression. Investors are reacting to two things. First, a drop in large ag equipment demand as farmers pull back on spending. Second, rising input costs squeezing margins. According to Deere's IR site, North American large tractor sales are expected to fall 15% this year, and management flagged persistent inflation and cautious customer sentiment as key headwinds. So, who is Deere? Deere is the world's largest maker of agricultural, construction, and forestry equipment. About 60% of revenue comes from its agricultural and turf segment, with the rest split between construction and forestry and financial services. The business is global, but North America is its profit engine. Deere's strengths: brand dominance, dealer network, and a sticky aftermarket parts business. Vulnerabilities: cyclicality. When farmers and builders stop buying, revenue drops fast. There's also exposure to commodity prices and trade policy. On the income statement, the pain is real. Revenue for the quarter was down 12% year-over-year, and gross margin fell from 28.3% last year to 25.8% this quarter. Operating margin compressed to 12.1% from 15.4%. Net income was $1.45 billion, or $4.80 per share, versus $2.1 billion, or $6.85 per share last year. Free cash flow for the trailing 12 months is $4.2 billion. Deere is sitting on $6.8 billion in cash, but it's got $38 billion in debt, most of that tied to its financing arm. Operating expenses are a mix. SG&A is relatively fixed, but cost of goods sold flexes with volume. Still, when revenue drops, fixed costs bite harder. Let's dig into how the narrative affects the company's outlook. Deere's revised guidance implies revenue about 7 to 9% below prior street expectations for the year. With gross margin down roughly 2.5 points and operating leverage working against them, I estimate operating profit could fall 15 to 20% below previous forecasts. Here's the math. A $1 billion revenue miss at a 25% gross margin means $250 million less gross profit. With fixed costs steady, most of that drop flows straight to operating income. So, we're looking at a plausible range of -15 to -20% impact on operating profit for the next few quarters. So, how much is Deere really worth? I ran a DCF Lite cross-check using the following assumptions. Near-term revenue growth of -8%, reflecting the cyclical downturn, gradual margin recovery to 14% operating margin over the next 5 years, a 9.5% discount rate, and a 2.5% terminal growth rate. That gives me a base case fair value of about $355 per share. If the downturn persists and margins stay low, the bear scenario drops fair value to $310 to $320 per share. On the multiple side, Deere is currently trading at about 1.8x sales and 13x EBITDA, down from its 3-year median of 2.4x sales and 16x EBITDA. For context, Caterpillar is at 2.2x sales and 15x EBITDA, while AGC is at 1.1x sales and 9x EBITDA. Deere's premium is shrinking, but it's still not cheap by historical standards. With earnings under pressure, the PE is less useful right now. Forward estimates are a moving target. For those looking to catch this particular falling knife, here are 3 analytical buy levels. Level 1, $355, anchored to conservative base case fair value. Level 2, $320, pricing in further margin pressure and a deeper ag cycle. Level 3, $280, deep value, forced selling zone if the thesis worsens. Here are the key risks to watch. Large ag equipment demand. Any further deterioration will hit revenue hard. Input cost inflation. If steel, labor, or logistics costs spike, margins could compress further. Dealer inventory levels. If dealers get stuck with excess inventory, future orders will slow. Competitive pressure. Caterpillar, AGC, and Kubota are all looking to grab share. Guidance credibility. If management cuts outlook again, expect more downside. If Deere can stabilize margins and show signs of demand recovery, the thesis gets an upgrade. If comps turn negative and guidance drops again, it's time to reassess. That wraps up our deep dive on Deere Company. Remember, this is analysis, not advice. Do your own research, consult a professional, and never catch a falling knife without knowing where the blade is. If you've got feedback or want to suggest the next stock for the show, hit me up. Until next time, keep your wits sharp and your risk management sharper.